How to interpret company earnings reports for stock price. Imagine trying to figure out if a company is doing well just by looking at its financial report. That's what investors do when they analyze earnings reports. These reports show how a company performed over a specific period, usually a quarter. They include key numbers like earnings per share, revenue, and operating margins. Earnings per share tell you how much profit the company made for each share of stock. When a company reports earnings per share higher than what analysts expected, the stock price usually goes up. This is because investors see it as a sign the company is doing better than predicted. But if earnings per share are lower than expected, the stock might drop. This difference is called an earnings surprise and can cause big moves in stock prices. Revenue is the total money the company earned from sales during that period. If revenue is growing, it shows the company is expanding. But it's not just about sales. How well the company manages costs also matters. If costs are kept low while sales grow, the company's profits will improve. Operating margin is another important number. It shows how much profit the company keeps after paying operating expenses. A high or rising operating margin means the company is managing costs well and making good profits. If the margin drops, it could be a warning sign that expenses are rising faster than sales. The price-to-earnings ratio compares the stock price to earnings per share. A high ratio means investors are willing to pay more for each dollar of earnings, often because they expect the company to grow. A low ratio might mean the stock is undervalued or that the company is facing difficulties. During earnings season, many companies releases their reports at the same time. Stock prices can become very volatile because investors react quickly to the new information. Listening to the company's earnings call, where management explains the results and future plans, can give you extra clues about the company's health. For someone just starting out in investing, focus on comparing the reported earnings and revenue to what was expected. Watch for earnings surprises and look at how earnings per share and operating margins are changing over time. The price-to-earnings ratio can help you understand how the market values the company now and what it might expect in the future. Using these facts can help you decide whether to buy, hold, or sell a stock based on how the company is really doing financially.